I'm Ollie Ludwig, the managing editor of ETF.com. We are the leading authority on news and data about ETFs and the company behind Inside ETFs, the world's biggest ETF conference. Before we get underway, everyone should know that they can ask questions at any time during the 60-minute webinar in the window at the lower right of your screens. Also remember that this presentation will be available to all of you 24 to 48 hours following today's webinar. Joining me today are Bill Belden of Guggenheim Investments and Mitch Zacks, a portfolio manager with Zacks Investment Management. Bill is a managing director and he heads product development at Guggenheim ETFs and at Ridex Mutual Funds. Mitch Zacks, as I said a moment ago, is a portfolio manager with Chicago-based Zacks Investment Management, and he is thoroughly steeped in economics with a BA in econ from Yale and an MBA from the University of Chicago. He also was an investment banker with Lazard Frères in New York before joining Zacks. And Zacks and Mitch was instrumental in this. He developed the indexes underlying the two ETFs we're going to talk about today. So I'm pleased to have Mitch here along with Bill Belden. But first, a bit about Guggenheim. It is the seventh biggest U.S. ETF company with about $28 billion in assets under management. And more than $6 billion of those assets are in its two families of BulletShares target date maturity corporate bond ETFs, surely one of the more interesting innovations in the world of ETFs in recent years. But today we're going to talk about another Guggenheim innovation and the nearly $1.4 billion in assets invested in it. I'm talking about the two multi-asset class income ETFs Guggenheim now markets. That's the Guggenheim Multi-Asset Income ETF, trades under the symbol CBY, and it has $1.3 billion in assets under management. And we're also going to talk about the international version of CBY, which is called the Guggenheim International Multi-Asset Class Income ETF. It trades under the symbol HDI, and it has $32 million in assets under management. Multi-asset class ETFs have attracted increased attention in the past few years as investors and advisors become more thoughtful and creative in the ways they respond to an environment of persistently low bond yields. One of the interesting details about these two Guggenheim ETFs is their launch dates, 2006 in the case of the U.S.-focused CBY and 2007 in the case of the internationally focused HGI. Now, in ETF years, that is a long time, and crucially, both funds launched before the subprime mortgage crisis created the financial markets and turned already low yields that prevailed in the first decades of the new century into the ultra-low rates we're all now so familiar with. The importance of ETFs like CBY and HGI is that they compensate for the low rates and the risks of reaching for yield on the far reaches of the yield curve. Those virtues are pretty clear, especially for the growing legions of retirees who want to put the stock market volatility of the past generation behind them as they get ready to enjoy their golden years. So what are these multi-asset class income funds that are chock full of income-generating asset classes such as REITs, MLPs, closed-end funds, preferred stocks, royalty trusts, and yes, common stocks as well that pay good dividends? Again, Guggenheim and Zacks saw the need for this sort of security quite a while ago. So let's open up the hood and see what's inside with Mitch Zacks and Bill Belden. So Bill, you want to kick it off here before we bring Mitch into the discussion?
I do, and thank you, Ollie, and thanks to all of those who are joining us on today's webinar. As Ollie mentioned, it was actually over 8 years ago now that we developed the concept for the multi-asset income ETF. And as Ollie mentioned, we were fortunate enough to be partnered with Zacks, who developed the underlying index that CBY, the multi-asset income ETF, is designed to track. We really looked at it in the context of trying to find an investment solution for advisors to use with their clients that provided access to regular and, most importantly, perhaps sustainable yields and returns. And in order to do that, we looked at a number of different asset classes that we could invest in that would achieve that intended result. To that particular point in time in the ETF business, most non-fixed income yield-driven strategies were really in dividend-paying stocks exclusively. And CBY was a ticker that we chose not just randomly, but rather because there was another ETF that was exclusively focused on dividend-paying stocks that we felt we could improve on in terms of the risk, return, and yield dynamics that CBY could actually produce. So certainly as we've headed into what most believe are the latter stages of record low interest rate environment, the past 8 years have been a very good one for shareholders of CBY who have enjoyed a very attractive rate of return over that period of time, and if not more importantly, achieved a consistent and steady yield on their portfolio to help support what their investment objectives are in terms of maintaining an income stream that again is sustainable and regular. So when you look at what drives the search for yield. Traditional sources of income have diminished, and the risks associated with those have increased. As I mentioned a moment ago, the low interest rate environment that we've been in for quite some period of time appears to be ongoing, although again perhaps in its later stages. What the need is for investors is still there. We as an ETF sponsor continue to seek new ways in which we can provide investors and advisors with sources of income that, again, are meaningfully impactful from a nominal level, but also sustainable over time regardless of the market environment. And certainly there are demographic trends that evidence the continued need for income, as one can just point to the aging of the baby boomer population to evidence that need of a regular and sustained stream of income. So as I mentioned, and Ollie mentioned at the outset, we were pleased back in 2006 to establish our ETF relationship with Zacks. And Mitch Zacks, who is the author of the index that both CBY and its international counterpart HDI track, worked closely with us, and I'd like to turn it over to Mitch to talk a little bit about, again, those beginning days, if you will, in the development of the index and some of the objectives that he was seeking to achieve through the development of the index.
Bill, thank you very much.
I want to piggyback on that, Bill, really quick. Yeah, absolutely. That's so early. I mean, I'm astonished. I can remember Greenspan talking about the conundrum and everything. You couldn't believe how low bond yields were, and boy, it's a lot worse now. And you guys saw it early. So yeah, definitely speak to that, Mitch. Thanks. Thank you, Bill.
Thank you very much, Ollie, and thank you very much, Bill. So if we go back in time and we think about what the world was like, and we look back at the 10-year yield, and we look back in the 85, the 10-year yield was about 11%. You fast forward 5 years, it falls to about 8%. You fast forward to 95, it's about 8%. At around 2000, around the dot-com crisis, you're talking about a 10-year yield still at around 6.5 to 6.7%. You go forward to 2006, and that yield over the past 10 years has gone from approximately 8% down to about 4.4%. So in 2006, you're looking at a 10-year yield at around 4.4%. So it's becoming harder and harder to get yield. And at the same time that's occurring, there's an increase in demand from an aging baby boomer population and just from investors in general in trying to generate yield. So at the same time you have decreasing supply in yield, you have increasing demand for yield. And what we determined to try and do is to figure out how can we provide yield for investors in a way that is risk controlled. And what we decided to do is to look at different asset classes where each asset class is generating yield but has not perfect correlation to another asset class. And basically by putting multiple asset classes, all of which are generating yield, into the same strategy, you're able to generate yield with substantially lower risk than you would be able to generate if you just picked one of those asset classes and tried to generate that yield in that one asset class. So what we were seeing happening with investors in 06 is that there was this demand for yield, and they were saying, listen, 5 years ago, 10 years ago, yields were at 8%. Now I'm earning 4.4% on the 10-year, and I need to generate a higher yield on my investment because they're income-based investors. And they would start going farther and farther out on both duration risk and both credit risk to try and get that yield higher and higher. And what was happening is they weren't aware of the risk they were taking because they were bearing much greater degrees of credit risk and much greater degrees of duration risk than what they wanted to do. So the answer was to take a portfolio that consists about 50% of common stocks, 10% in American depository receipts, 10% in master limited partnership, 10% in closed-end funds, 10% in REITs, and 10% in preferred shares and royalty trusts, and combine it together. And in each of these asset classes, make a screen for a quantitative measure to try and identify those companies where the yield will be sustained and where the liquidity is strong and there's not going to be any trading implications going on. So we're doing that across each of these separate asset classes with a different algorithm that's running in each of these asset classes, and then combining it together to get a portfolio that can generate a yield that is currently at around 5.1%, but has a greater degree of diversification than if you took any one of these asset classes and moved towards the highest yielding investments. And that was the innovation or the invention that we collectively did with Guggenheim, is that we figured out that by putting different asset classes together, you reduce the overall risk of the portfolio, basic modern portfolio theory, but by having a selection criteria in each of those asset classes towards higher yield and sustainability of that yield, you're able to create a strategy that can generate a yield in a relatively less risky manner than you would in any one individual asset class. And we've seen it run
Mitch,
through...
can I chime in really quick?
Sure.
Any deep, compelling reason for the 10% breakdown of the different asset classes apart from the equity piece, or is that just what worked out sort of to create a little bit of symmetry from one side to the other of the equity versus non-equity pieces of this overall approach?
You generally, there's a general belief at Zacks that over long periods of time, equities will tend to perform in excess of similar yielding fixed income investments. So if I sit here and I look at Target's bonds and I say, well, the Target equity right now is about 3.3%, and the 2024 March Target bonds are at 3.3%. And the question is, if I hold both, if I take one box and I put the equity in one box and I put the fixed income in another box, which box generates a greater return over a 20-year period? And we're very confident saying that the equity box, because you get the yield, plus you also get the equity, the price appreciation, will generate excess return. So we definitely wanted a slight bias towards equity and away from fixed income in the strategy. Additionally, we wanted to make sure we had master limited partnerships in there, and we need to keep the master limited partnership exposure, I believe, below 20% for a 1940 Act company. So that was a constraint that we placed on it as well. But it really was driven by the concept of having a overall lower diversification while still maintaining this bias towards equities. And the 50, 10, 10, 10, each of those 10% satellites around the 50% of common stock has enough diversification that its inclusion reduces the overall risk of the portfolio.
Thank you, Mitch. So with that as kind of a backdrop to the development of the multi-asset income indexes that drove the development of the ETF that tracked the performance, as Ali alluded to earlier, we launched CBY in September of 2006, and followed that with the launch of HDI in July of 2007. And
by the way, Bill, just to chime in, just I want to make it perfectly clear, we've been emphasizing this early recognition of this opportunity slash way for investors to address a problem. This is CBY was the first to market in this category, and it remains the biggest in terms of assets under management. So you've clearly leveraged the first to market advantage that people often talk about in the ETF slash fund industry. Anyway, sorry to interrupt, Bill.
No, thanks. And as a matter of fact, I mean, we didn't see the next multi-asset ETF come out for another 6 years after the launch of CBY. We heard a lot of skepticism around how CBY would actually deliver to shareholders, and finally, a bunch of or a handful of other products have been subsequently launched to try to seek to deliver upon what CBY has done so well. If we speak to, the comments that Mitch had made around the potential benefits over the long and the short term as it relates to a multi-asset approach, we see that, there's two things that we're seeking to achieve here. It's delivering an attractive total return over time, and certainly most folks recognize the impact that dividends can have on driving total returns, particularly in periods of low price appreciation. We'll demonstrate that in a second. Secondly, we talk about the protection against volatility. It's certainly not immune from volatility, but having diversification across multiple asset classes can help contribute to an element of diversification that can mitigate that. And then lastly, we talked about the important role of dividends as it relates to the total returns that investors realize when they reinvest those dividends. So we certainly see a lot of investors taking dividends in cash off of CBY and HDI, but to the extent that you reinvest those dividends, you certainly have seen the power of that over time. And this slide here that shows the power of income and the reinvestment of that demonstrates the fact that if you went back to the S&P 500 back in 1970, and you just looked at the price appreciation relative to the return that you would receive from reinvesting dividends, you can see the notable impact that a dividend reinvestment strategy can have. So again, with that being an element of multi-asset as well, and it's compounded by the what I have alluded to earlier, which is, again, one of the key underpinnings of the development of the index and CBY, the ETF, which is not just an attractive nominal yield consistently over 5%, but the sustainability of that through market cycles. And if you look at the history of the distributions of CBY, as shown here, you can see that the median distribution on a yield, from a yield perspective, has been 5.40%, and the average has been about 5.97%. So we like to think that, and certainly in a low interest rate environment when investors are seeking alternative sources of income, that one of the key things that they need is the sustainability of that income source. And so one of the things that investing across a number of different income generating asset classes provides you with is the ability to maintain or sustain that income stream.
And I think it's important to realize that with a diversified income stream, you're generating yield, and especially, but you don't have the same sort of exposure to potential interest rate fluctuations. If you see interest rates rise, and we talked about how interest rates have fallen from around 10% in the early 90s to around 2.3% today. This is unprecedented. It's been since essentially 1949 when we last saw interest rates this low. Most likely I look at this and I say, well, interest rates are going to rise, but even in a rising interest rate environment, you still need this demand for income. And what is an investor to do? You have this perception that rates are going to rise. They've stayed low for a long period of time. They may continue to stay low. But when they rise, you don't want to be overexposed to segments of the marketplace that are highly interest rate sensitive. So looking at this list of the components right now of the CBY, and I look at this, I can say, well, the master limited partnerships and the preferred shares and potentially the closed-end funds are the most interest rate sensitive of the elements of CBY. But in a rising interest rate environment, if that's occurring because we're seeing economic expansion in the U.S. and the jobs are increasing and wages are going up, that should actually help the dividend-paying stocks. So you see in these scenarios where you have a rising rate environment, you're going to have certain segments of CBY that are going to get hit, but the other segments are going to benefit from the same economic forces that are causing interest rates to rise. And that, at the core, is the basis of multi-asset income investing, is that by putting different types of securities together, all of which are generating yield, you're not as exposed to the economic fluctuations that would hit any one of those segments of CBY.
So, Mitch, let me chime in there really quick with that, because you're raising a really interesting point there. By steering clear of the bond market, you're steering clear of some potentially substantial duration risk, right? Interest rate risk. What vestiges of that sort of duration risk are still present here that one should be mindful of? You made a good point that dividend-paying stocks can help offset that, but as you look at some of these other categories, MLPs, REITs, closed-end funds, preferreds. Can you shed a little light on what kind of, to call it duration risk maybe isn't totally accurate, but something that's analogous to duration risk in these other asset classes? How should investors think about that, those particular risks in the rising rate environment that you were laying out for us?
If you look at master limited partnerships, for instance, they're priced primarily on a premium or spread on the 10-year yield. As the 10-year yield comes down, the pricing is then, for the valuations, a premium upon that. And so they would be one of the more interest rate sensitive groups. Is there duration risk? It's not duration risk in the same extent that you have duration risk with exposure to a fixed income instrument that's a 30-year treasury, but it's duration risk in the extent that the valuation of these master limited partnerships are completely dependent on that 10-year yield. As that 10-year yield goes up, valuations have to decline. Preferred securities are also going to be highly dependent because essentially they're bonds that are structured to interest rate fluctuations. Closed-end funds are a more interesting story. We're looking, what we're looking for are closed-end funds that are trading at a discount to net asset value. And what we found over time in trying to explain why certain closed-end funds trade at a discount, it has to do more with investor sentiment. So if retail investor sentiment is picking up because the economy is picking up, you might see those discounts to net asset values actually narrow in the closed-end fund space. In terms of real estate investment trusts, also, interest rates go up. REITs are a little bit more interest rate sensitive than common stock. If I think of an apartment building or I think of Procter & Gamble, I think which one has its revenue stream changed most dramatically by rising interest rates, it's going to be the REIT because financing isn't going to be available to potentially purchase new apartments to lease out. So you're talking about all investment is interest rate sensitive. If interest rates go up, it has to hurt almost all risky assets that are valued based on discounted cash flows. But it's going to hurt the equity-related investment assets much less than the fixed income-related investment assets. So you do have some duration exposure, but it's substantially less than if you obtained a 5% yield in the fixed income market. And that is why I think that you're seeing this groundswell of activity around CBY and why you've seen this increase in the asset base, is because it's an alternative to searching for yield in the fixed income space where you're forced to go out in duration and you're forced to go up with credit risk, and by the time you get a 5.1% yielding fixed income instrument, you're taking substantial risks. And I'm very comfortable saying that I believe we're taking less risks with CBY and delivering the same degree of yield.
Awesome. Thank you, Mitch.
So if you look here, Mitch spoke to each one of those security types or asset classes, if you will, that are part of the index methodology that drives CBY. One of the aspects that we speak to is not just the income driving components, but obviously, as Mitch alluded to, the risk and a reflection of the risk and volatility that's associated with investing in each one of these speaks to the diversification components of a multi-asset income strategy here. Here's a fairly busy table but it does reflect how each one of these individual asset classes relates to the others in the strategy from a correlation standpoint. And so clearly, as Mitch alluded to, you can see the benefits of investing across a number of different asset classes as opposed to just a singular one. Speaking a little more specifically about CBY and HDI themselves, we do have these two ETFs, as Ollie mentioned, they have a little north of $1.4 billion in assets under management combined. And while CBY itself focuses primarily on domestic securities, HDI itself is, I think, rightly considered the international version of CBY, if you will, to take into account some security types that are available through international exposure as opposed to domestic exposure. Each one carries approximately about 150 securities. So when talking about diversification, we can point to diversification at the security level in addition to at the asset class level. So how have CBY and HDI performed over time? As I mentioned, and Ali mentioned at the outset, the CBY was launched back in 2006 on September 21st, and HDI in July of 2007. So we have a nice history there as it relates to, what the performance has actually been for each one of those respective strategies from a total return perspective, on top of the yield that we have spent a lot of time talking about that each one respectively delivers. Here's another visual as it relates to how the movement in those returns have been generated over time. So an investment of $10,000 back in the beginning of 2008, which is the first semi-annual period that both of them were available on the market, is shown here in contrast to your typical domestic and international, or global rather, benchmarks, which would be the S&P 500 index and the MSCI World Index. Again, in both cases, very attractive comparable returns.
I just want to stress that what we're trying to do here is we're trying to provide participation to the upside in the equity markets, but we're focusing on trying to provide some of those returns in yield. So the goal here is to generate a yield-based strategy. And we talked about this a little bit earlier, but to understand this, you look at what's in the index and what's in the ETF, and you realize that, well, effectively by having multiple products, you're able to better generate that yield. So if we look at what happens in an economic expansion, which is what I would probably be expecting, I would expect common stocks to do relatively well. I would expect ADRs to do relatively well. I would expect master limited partnerships to come under some pressure. I would expect preferreds to come under some pressure. I would expect the closed-end funds to do relatively well. And I would expect the REITs to lag the market a little bit. So in an expanding economic environment, you're in a situation where you have certain asset classes doing well and other asset classes not doing well. If you reverse that and you say we go into a recessionary phase, well, I would expect the common stock to come under pressure. I would expect the ADRs to come under pressure. But the master limited partnerships, the preferreds, and the closed-end funds to some extent should do well, because with that recessionary pressure comes a slightly lower interest rate environment. And that's the key to understanding what we're trying to do. We're not necessarily trying to trounce the market in the strategy. We're very, I'm happy that we have been able to outperform the S&P 500, total return since inception. But what we're really trying to do is provide a yield for the end client that has a degree of diversification that is greater than they could get on their own if they went directly into the marketplace.
So thank you, Mitch. I mean, that does speak to some of the variables that represent economic trends that can impact multi-asset income classes. So we speak to the development and the index methodology that supports CBY and HDI. Again, I think that it's provided a very attractive income stream and a total return profile over the course of its 8+ years now of history. We're very optimistic about what the future holds given the current environment around both HDI and CBY. So again, I think that we'll continue to communicate, and I would encourage you to take a look at our website as it relates to what's happening with CBY and HDI at any particular point in time. We do have a number of resources that are available to support your analysis and information needs on CBY and HDI. We would always encourage you to first give us a call at our ETF Knowledge Center, which you can reach at 1-888-949-3837 or 1-888-YETF, which is the catchy acronym that we came up for that phone number. Otherwise, you can reach us at our website, which is GuggenheimInvestments.com. And through the ETF portion of the site, we have fact cards, prospectuses, and additional information on that supports both CBY and HDI. We do update the data on there from a portfolio characteristic perspective on a quarterly basis. And as you know, with ETFs, we're updating holdings on a daily basis. So we encourage you to visit us both at our website or give us a call in the ETF Knowledge Center to get additional information for us. One final slide I'll show here, which is a representation of our distribution support that reflects both our ETF Knowledge Center and the coverage map, which you probably have a difficult seeing the individual names and numbers on that. But again, if you reach out to the ETF Knowledge Center, they can put you in touch with the RVP that covers your particular geography. Here's our obligatory disclosure that we're required to represent the material that we discussed today. And with that, I will turn it back over to you, Ollie, for follow-up Q&A.
Thank you, Bill. We can circle back to that phone number too, so that participants in the webinar can have a quick way to get in contact with you guys if they need to. So I wanted to say thanks for giving a lot of time for questions. Again, anyone who wants to ask a question can do so in the lower right of your screens. We've already gotten plenty from the audience, so thank you. So we've got a lot to chew on, gentlemen, so fasten your seatbelts. Let me just start with a very general one. And Mitch, you maybe touched on this a little bit a moment ago in your last comments, but give us a sense of where this is going to fit in a portfolio. I'm tempted to see it as perhaps a piece of an alternative sleeve. Yes, it serves this income function, but is it going to exist alongside a bond allocation? Is it going to replace it entirely? I'm short of asking you, how I want you to build my portfolio, Bill. Just give us a sense, and Mitch, maybe you can chime in as well, please.
Okay. If you have a client that's coming to you and saying, listen, Charlie, I have a low yield environment, and I really need to make, I need to have a higher yield. And I have this mortgage-based REIT, and it's paying 11%, and I want to put 20% of my assets into this mortgage-based REIT, and we won't name names. What do you think? This is a much better alternative for those clients who are looking for yield than going into any one of these asset classes and searching for that 5% yield. So the client is much better off having a percentage in equities that are yielding, and the equity percentage of the portfolio yields slightly less than the overall percentage of the portfolio, and combining that with slivers of higher yielding investments in different asset classes. And by combining the slivers of these higher yielding investments in different asset classes with the common stock, you're able to generate a relatively high yield, but not have the same level of risk as if you went into these asset areas that traditionally offer yield and try and get a 5% yield. So the answer is that yes, it is part of a sort of an alternative slice, and it can be viewed as that, but it really is a means for investors to generate yield in a low interest rate environment without going off the risk spectrum on the fixed income side or the REIT side or something of that sort. Holly, I hope that answers your question.
Yeah, Bill, anything you want to add to that, or did Mitch cover it pretty thoroughly in your judgment?
I think he did cover it pretty thoroughly. I would just, the only thing that I would add to it is that, we see a number of different applications that advisors are using. It's more for consistency of income, and so hence it's typically replacing more of the income part, or rather more of the fixed income part of the portfolio allocation than it is the equity part of the allocation for a lot of what we've talked about today, namely, again, the sustainability of the income being attractive relative to other sources of yield, and yet at the same time, it has, equity characteristics. So I would say that it kind of fits in with that more of a hybrid type of approach, which is perhaps another way of saying, alternative as you characterized it.
Okay, and is there any grounds to see this as a total return approach? Is just a very different way of skinning that cat, or is that a bit of a stretch?
No, I think it's very possible to see it as a total return. And if you look historically, the total return of the strategy has exceeded the total return of the S&P 500 since inception. But it really is seen, I think, as a way of generating yield, and that's why we're seeing its growth effectively.
Yeah, and I would just echo that. I moved that slide back up that shows the performance of CBY and HDI against S&P 500 and MSCI World, respectively, and I think that would evidence the fact that from a total return perspective, the products perform very well in comparison to market benchmarks.
Now, at the risk of making you squirm, Bill, part of the consequence/virtue of having launched so early is that you lived to tell the tale of 2008, 2009. How would you characterize how CBY or even HDI performed in that really troubling market environment that we all lived through?
Yeah, it certainly was a troubling period, and I don't think that that CBY was spared from that. We do talk about the benefits of diversification, and we talked about the correlation and the strength of the correlation statistics from an asset class perspective, but certainly not immune from volatility. And when correlations across asset classes are basically all going to one, as they were back during that period of time, you'll certainly see that impact of CBY and HDI, and those funds were impacted in market-like returns during that particular period. But again, they bounced back quite strongly on the heels of that.
Okay, we have one question from the audience that this should be pretty straightforward to answer, but these data that you're sharing with us, Bill, backdated or real performance?
Real performance. All of the data that we're showing on this presentation is actually performance for the ETFs themselves, live since launch and subsequently to that. So again, we've spent some time talking about the benefits of being out in the market for such a lengthy period of time, certainly in ETF terms, a lengthy period of time. And so one of the benefits of that is that we get to show these numbers as live returns.
Okay, thanks. Another audience question. Talk about the correlation of the asset classes. Are they highly correlated at this time, or relatively uncorrelated?
Well, we had a slide that I think I'll take you back to. Again, admittedly, the table is a little bit busy, but it speaks to each one of the asset classes that are components of CBY, and how they are correlated to each other over time. And so this is as of the end of September, and I think that you just need to acknowledge or recognize when you look at each one of these that they are not all equally weighted, right? So we talk about the equity part of it being roughly 50% of the portfolio over time, and the remaining sleeves, more or less managing around a 10% type of sleeve. Generally speaking, they will move north and south of that mark depending upon what's happening at any particular market environment or rebalance period. But I think that if you look at that slide, you can actually see, the correlation statistics that, there certainly aren't, generally speaking, sub-50 numbers there, but, they're well below a 1 correlation as it relates to how they interact with each one, with one of each other.
Okay. Now, what about portfolio turnover? Can you speak to that in the indexing methodology, Mitch, or in the real world funds, Bill?
Sure. In our selection criteria in each of the asset classes, we're trying to make sure that we don't have very, very high turnover, and we're trying to make sure also that we have sufficient liquidity. Additionally, we're using a quantitative methodology in each of these asset classes to try and make sure that the yield or the income that's generated from that asset class is maintained over time. So the portfolio is rebalanced on a quarterly basis, but I don't think our overall turnover is substantially higher than what you would see in an actively managed strategy.
And I would add that.
So to be perfectly, go ahead. I'm sorry. Please, Bill.
I was going to add to that from the ETF side of things that we do rebalance the fund on a quarterly basis in conjunction with the index rebalance. That one of the beauties of the ETF is that we're able to do so on a very efficient basis in terms of working with our authorized participant partners to move securities into and out of the portfolio pretty easily. Again, I think if you look at basically what the tracking performance of the product has been over time, it's been very attractive in terms of its performance relative to the performance of the index, which again I think speaks to how efficiently, in part, we've been able to execute around the index rebalances.
Okay, now to squelch any potential misunderstanding, there's a couple of questions that have come in here. This is a passively managed strategy. It's an index strategy, not active, right? And a related question is, are you buying and selling securities within the ETF on a daily basis?
That's a good question. It is purely a passively managed product. I would add, however, that we as the investment advisor and being charged with tracking the performance of the underlying index have used optimized portions of the portfolio to track that. So, for example, if there is the closed-end fund that's part of the index that is not easy to acquire or otherwise is easier to implement within the fund's portfolio, we will buy proxies for that or otherwise shift portfolio holdings to better align with the index. So, again, in the purest sense, it is passively managed. There aren't active decisions being made. But again, the objective here is to track the performance, so we're not trying to add alpha on top of the performance of the underlying index.
It's a rules-based index where the design of the index is designed to make a sustainable dividend and potentially outperform in each of the asset classes.
And to the second half of that question, Ali, about are we buying and selling securities on a daily basis, generally the answer to that is no, we're not. Certainly as we get purchases into the fund through creation units, those are coming in almost exclusively as in-kind contributions, so the securities are actually added to the portfolio. Likewise on the redemption side. But again, around rebalance activity, while most of that happens on an in-kind basis, there may be selective security buying and selling in those instances, I should say, but on a day-to-day basis, no.
Okay, great. Now, there's another potentially straight-ahead question, the cost of these ETFs, CBY and HDI, in terms of expense ratio. Maybe add a little color to that, Bill. Certainly, there may be some perceptions out there, with the likes of Schwab or Vanguard offering funds at 4 or 5 basis points a year. Anything that's higher than that could easily be mischaracterized as a quote-unquote high-cost security. So let's start with what are these costs, and give us a sense of what folks are paying for when, as you formulate and charge that annual expense ratio, please.
Sure. CBY has an expense ratio that's actually capped at 65 basis points from a Guggenheim perspective. Now, we do publish higher expense levels than 65 basis points because we're obligated to reflect the fact that the fund owns closed-end funds. And so the expense ratios of the underlying closed-end funds are factored into a total operating expense ratio that's higher than that 65 basis point cap. But to the degree to which it's higher, that's a reflection of that ownership of closed-end funds. And the same can be said for HDI as well. It's 70 basis points, but to the extent there are higher expenses shown, it's a byproduct of owning closed-end funds and the expense ratio associated with that particular allocation. And since you mentioned Schwab, Ali, I'll take this opportunity to remind folks that are dialed in that both of these funds are available on the Schwab ETF One Source platform, which provides commission-free access to investors to buy and sell without commissions. And certainly as we established our partnership with Schwab a year and a half ago, these were important parts of that particular lineup, so both CBY and HDI can be accessed for Schwab clients on a commission-free basis.
Well done, Bill. That's the wonderful world of ETFs. I had overlooked that interesting fact, but that's not a trivial detail to put into the discussion. Let's talk about the distribution for a moment. There are certainly a number of questions about the dividend. I think, Mitch, you may have said 5.1. I looked at ETF.com analytics. We have 5.14. That's pretty darn good relative to what the duration and credit risk you might have to take to get that in various pockets of the bond market. By comparison with some of the competing funds in this space, I'm certainly not asking you to disparage your clients or your competitors, but this is sort of a middle-range dividend here. Can you give a little color on that, Bill or Mitch? And then we can talk about looking forward. What kind of expectations should clients/owners of these funds expect with regards to the distribution on an ongoing basis, please?
I would just say, Ali, in a very low interest rate environment, traditionally, the higher yielding securities will generate excess returns over time. It happens amongst common stocks. But in a very low interest rate environment, you want to be a little bit cognizant of going too far out on the yield spectrum. And so I'm very, very comfortable where the yield is of the portfolio. And, with interest rates, the 10-year around 2.3% and at all-time lows, I don't think you want to be stretching it too high. And it's very easy to stretch it higher. You simply give a bias towards those asset classes in the multi-asset structure that tend to have a higher yield. So the more you move away from common stock, the higher the yield is of the portfolio, and overall that's going to occur. because for every dollar you move out of common stock into preferreds, you're going to get a much, much higher yield occurring. For every dollar you move out of common stocks into master limited partnerships, you're going to get a higher yield occurring. For every dollar you move out of common stocks into closed-end funds, you're going to get a higher yield occurring. But all three of those groups that I talked about are the most interest rate sensitive of the various asset classes. So there's no, the lunch is there, but you can't get the risk without the return. In this instance, the return is coming through yield. As you increase that yield even higher, you're taking more and more risk. And I'm much more comfortable taking less risk, getting a above average yield, getting a yield that can be sustained through both up interest rate environments and down interest rate environments, and having a more stable product over time.
And I would add, if you look at the slide, that I put up, I took us back to that page that I think evidences one of the key attributes, I believe, of the multi-asset income approach, which is, at least in the manner in which CBY and HDI delivers it, it's the consistency of that income, right? So if you look at, and again, being fortunate to be in a position to demonstrate a relatively lengthy period of time, including that during the credit crisis, you see, statistically there and visually, that both in nominal terms and on a dollar basis, as well as what the yield has been over those periods of time, you've got kind of basically a baseline during market volatility. You've seen that spike a little bit, but otherwise you've seen a very attractive source of income, and by attractive, what I mean is both in a nominal and on a consistency basis, what that has been. And if you look at really one of the, I'm going to point to it as the key attribute of CBY, it really is that alternative source of income that's consistent and sustainable over time. Obviously, we can't speak to what the future may hold. This is looking back, but by the way in which the strategy is constructed, we would expect more of the same as opposed to dramatic differences depending upon shifting market conditions. I think
okay.
Also, while this is representative of CBY, and we talk about CBY's yield being consistently in that 5+% area over this entire period. HDI is behind that, which I think is consistent with international exposure. Right now, we're quoting a 3.73% yield on HDI, again, which I think has been relatively consistent. There's been a little more volatility associated with the international exposure than domestic exposure, not surprisingly. But, it's managed in the same way as CBY is, and so I think investors should be cognizant of that for international income-oriented securities.
Yeah, I'm glad you brought HDI back into focus, Bill. I think at the beginning, in my introductory remarks, I observed that CBY has assets under management of about $1.3 billion, and HDI is considerably lower. I think in around 30 million, as I recall off the top of my head. Does this speak to the fact that people maybe haven't woken up to the international yield opportunity, or is there potentially maybe a sentiment out there like, hey, if I'm looking for alternative income, I've got it right here in CBY, a very liquid security. The international piece, as it relates to the overall diversification pursuit in a portfolio, may not be as important in this regard, or am I completely off the mark with the premise of that question?
Because in HDI you have this focus internationally, you're going to have a slightly smaller degree of diversification. So if you look at CBY, you have 10% of CBY in ADRs, but in HDI the majority is international. So CBY has slightly more asset classes than HDI. But they're both very, very good strategies, and I would encourage people who are using CBY, and there are a lot of people who are very comfortable with the strategy, to try using HDI as well and seeing what happens when we apply similar quantitative criteria to the international sector.
Okay, that's great. Now, there's one question here that's interesting. I didn't actually double check on the premise of this, but there's been a relatively large drop in the value of CBY since the beginning of September, perhaps twice as much as the S&P. Can you put that into perspective for our listeners, Bill or Mitch?
Sure. There is volatility in the strategy. The drop that we've seen recently has to do with some weakness that we're seeing primarily amongst energy stocks. We give a bias on the equity side towards companies that have low payout ratios. So when we're looking at things with low payout ratios, we're very comfortable saying that statistically over long periods of time, common stocks that have low payout ratios will outperform common stocks with similar dividend yields that have high payout ratios. And those companies that have the lower payout ratios tend to be more in finance and in energy, and those sectors have been slightly under pressure. It's nothing to be concerned about. It's par for the course. It happens from time to time, and I would anticipate going forward that returns pick back up to the normal level. But again, our goal here is not necessarily on massively outperforming the S&P 500. It's in making sure that the companies that are paying those dividends are sustained over long periods of time. If those dividends are sustained, and you're looking at this great graph Bill has put up here, and you look what happened in 08 and 09, what happens is the price falls, the income is maintained, the yield goes up, and it becomes a more attractive security. And that's exactly what we expect to be seeing happening in the securities in the portfolio. If prices go down and the income, the dividend payment is not cut, you're going to see the yield rise. As that yield rises in a lower rate environment, it starts to come back. And that's exactly what we saw in 08 and 09. And that's also a good reason why over long periods of time, dividend-paying stocks have outperformed non-dividend-paying stocks. You see the outperformance occur slightly more in general in down market environments and up market environments, because in the down market environment, the yields tend to increase.
Okay, I'm glad, Mitch, that you brought energy into focus there a moment ago in explaining the volatility at times of a security like CBY. Certainly from an asset class perspective, you guys have made a pretty decent case to suggest that this is a good way to diversify your streams of income and end up with a good solid yield with a lot less risk than you might incur in various pockets of the bond market. But as I look, apart from the asset class diversification, I look in terms of through the lens of sectors, and I see a fund like CBY has quite a lot of energy in it and quite a lot of financials. And then I'm tempted to think, oh, well, that's not diversification. I'm maybe concentrating into those two sectors, and maybe that's sensible at times, and certainly at times it's not. But just the idea of being concentrated might give me pause. Am I thinking through this incorrectly? Walk me through this a little bit.
Sure. If you're focused on high yielding U.S. equities, there really are four sectors potentially you're looking at. You're looking at finance, you're looking at utilities, you're looking at energy, and you're looking at consumer staples. You're not going to find a lot of technology companies that have yields that, when included in the portfolio, will get the yield of the portfolio to where you need to be. So there is a bias. There is an overweight to some extent on energy, but that's also because we have MLPs and some royalty trusts in the portfolio. Over long periods of time, the level of overweighting of these sectors is appropriate to be able to generate the level of yield that we're looking to generate. So if you start from the premise that you're focused in the income pool, you're going to start with overweighting four sectors, and here we're overweighting two of those sectors instead of all four of those sectors effectively.
Got it. I'm going to ask one more question here. We're starting to run out of time. I think this is an interesting one. I think, judging by the questions coming in, certainly I think folks are definitely tuned into the need for some kind of alternative income source. An interesting question came in from the audience that speaks to a much bigger picture as this trend for multi-asset class income generators and just the search for alternative yield continues as baby boomers plow into these multi-asset income ETFs. Is there a potential for a bubble here? And is this an accident waiting to happen? Either of you can take that one.
Sure. There's a tendency that when we experience bubbles historically, we see everything through the lens of the recent history. So because we lived through this bubble in 08 and we lived through a dot-com bubble in 2000, we have a tendency to look at everything and say, well, if it's an asset class and it's going up in value, it's a bubble. And in reality, what you're looking at here are very, very large cap companies hundreds of billions, if not trillions of dollars of potential market cap. And the concept that, well, this is a bubble is just, I think, very, very far-fetched. What there is to be said is that if you have a stock and the stock is generating a dividend yield of 4% and treasuries are 2.3%, that stock's going to be a very, very attractive stock. If interest rates rise to 4%, that dividend yield ceases to be as attractive. And I would say that, that should, as long as there's this differential between the yield we see on the S&P 500 and the 10-year yield on the 10-year Treasury, you're going to continue to see movement into that until that narrows. So, it's like saying there's a bubble in Treasuries right now. Is there a bubble in Treasuries? No, there's trillions of dollars, hundreds of billions of dollars changing hands on a regular basis, saying that the 10-year Treasury yield is 2.3%. As long as that 10-year Treasury yield is at 2.3%, anything yielding over 2.3% is going to be relatively attractive until those yields start to converge. And at that point in time, that higher yielding investment will not necessarily be as attractive, but we're still in this low interest rate environment where there's tremendous pressure on investors to search for yield. And that's what's continuing to drive these companies that have above average dividend yield. So I don't think that there's a bubble at all. I think it's a reflection of the economic variables in play. And as those variables tend to converge on each other, you may see some slowdown. But in fact, what we're seeing is the opposite. We're seeing yields continue to fall. They began the year at around 3%, and they're now at about 2.3%. And that was not what was expected at all. And so as this disparity continues, the movement into income-producing investments is going to continue as well.
Thank you, Mitch. I thought, Bill, you might want to throw up that number to Guggenheim before we call it a day here, in case any of the attendees want to contact you to discuss any of this further.
Yeah, sure. And while I'm doing that, I wanted to add a response to a couple of questions that came in about Morningstar and categorization. I mean, Morningstar is one area that hasn't really caught up with the notion of multi-asset investing from a categorization standpoint. So CBY finds itself in a large cap value category when we would spend a lot of time talking about the notable distinctions between multi-asset income portfolio and your typical large cap value portfolio. So I wouldn't make a lot of decisions around how a Morningstar rating on CBY should impact a buy or sell decision. Just note that, as we've brought some of the others in the ETF business along in the multi-asset income, we're hoping that Morningstar finds its way there to provide a better comparable for this particular product. So with that, I'll highlight the number that you mentioned, Ollie. Thank you for that. It's 1-888-949-3837. Or again, we encourage people to visit our website as well at GuggenheimInvestments.com.
Great. That's great. I wanted to remind all the attendees, thanks for everyone for attending. Remember that your attendance does qualify you for CE credits. And also, as I said early in the presentation, the deck will be available to all of you in 24 to 48 hours. And you'll get an email telling you how to access it. So that concludes our Expert Series webinar on the power of multi-asset income ETFs, income diversification, and more. I want to thank Bill and Mitch for being my guests. And again, thanks to the audience for attending and for submitting some very thoughtful questions. On that note, on behalf of my guests and my colleagues here at ETF.com, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.